There's a couple things that happened over the weekend that I thought was pretty interesting, especially for entrepreneurs, small business leaders, nonprofit leaders, and that is this ongoing weather forecast about what is the economy going to do and where we're going to go. And what was really interesting to me was listening to Larry Summers, who used to be a very high-ranking person in terms of Fed and Treasury and everything in the Obama administration. And Larry Summers came out and said, hey, everybody's talking about maybe the Fed's going to raise a quarter point in the month of March. And I think it's March 16th, 18th, or something like that, Kelly. And I think they're also going to have economic stats come out on that day, too. But Larry Summers was saying, hey, I think the Fed is behind the curve on raising rates. And it was headlines, it was on the weekend editions. I was like, wow, this comment's getting a lot of airplay, even in like basic business news. You didn't have to dive deep into the Wall Street Journal to find it. It was like front and center over the weekend. There's no Super Bowl, and baseball's in spring training, and March Madness hasn't quite started yet, so news like this kind of gets up above the clouds. And the point that I think what was being made there was that the Fed raised rates like a quarter point before the holidays, quarter point at the holidays, quarter point. So everybody keeps hearing quarter point, quarter point, quarter point. Well, guess what's been happening? We've had unemployment has gone down and the economy is heated up in a couple areas, which you might think some of those are good stats, and they are at a certain level, but this overheating is driving inflation up a tick again. And the Fed has said that until inflation looks like we can get it down to 2% a year, so that in a given year you're only experiencing 2% increase in goods and service and gasoline and eggs and everything that you buy, until we get there, he's going to have to keep raising the rates, because raising the rates makes money more expensive, which causes the economy to cool and slow down a little bit so that the growth is more in balance and predictable. And so Larry was saying the Fed's behind the curve, meaning he thinks they need to raise a half a point here in March. And what I think that means is, I look at it in terms of debt for business. You may have a floor planning arrangement with people. You may have equity loans. You may have equipment leases you're considering. Money is going to keep getting a little bit more expensive than it is now, and it's already fairly expensive as we go to mid-year. And so he's looking at a half a point, meaning that the Fed will probably then go a couple quarter point raises after that. Well, all the major banks had set this target of like the national rate, the Fed rate would hit about 5.25% and then maybe roll back from there as the economy cools down. They lower the interest rates, which also means mortgages would come down, so the housing market could perk back up, because there's a lot of people, mortgages, title insurance, escrow companies right now are hurting because the volume is very, very poor in the American real estate market. Prices haven't come down in all markets, although they're dropping precipitously in places like San Diego, San Jose, Austin, and Phoenix, Tucson. But that stood out this weekend. And so what does it mean? I think it means that we all should be a little bit conservative about spending, a little bit cautious about debt as we get into mid-year. And so I was watching that very carefully this weekend, and I thought, wow, that's the first thing where the weather forecast hasn't changed from this kind of cloudiness that we have on interest rates, expensive money, and the economy in general to be a little bit sunnier. Now, a lot of people have jobs, and I'd like to talk about that for a minute. So, hey, BIZ DOC, if unemployment goes down, isn't that a good thing? It is, but when unemployment drops too fast and too far in certain markets, it creates a sudden uptick in wages. Here's why. You probably heard about a lot of tech layoffs that have been happening. As a matter of fact, there was, I think, 200,000 tech layoffs last year. I think there's like a layoff.com or something like that. Kelly will put the link in the chat that tracks all this. But there has already been, just this year, about 120,000 layoffs in tech. Now, on a national basis, what does that mean? Well, if you go back to 2001, what was happening is there was unemployment in tech was down so low that engineers were coming in at artificially high salaries. Now, everybody's got to eat, and everybody's got to pay their rent and invest and do things like that, have a good life and pay off student loans if you're a young engineer. But when the prices for labor, which is the wages that you and me get spiked up because of a labor shortage, it creates very sudden inflation on the other side because the companies are having to pay more for the employees, and it's sudden, and that means they raise the prices of whatever it is they make, whether they're making software or it's ads, ad networks, whatever, the prices go up. So when unemployment drops too fast, wages rise way too fast, and it's an inflation trigger. So the Fed's trying to push that the other way. We want to see steady wage growth in America so that people have a little bit more next year than they did last year, and they can, raise their family and do all the things they're going to do and pay off their student loans and what have you. But there's a lot of it that becomes interrelated. So I think for businesses and for those of us buying houses and doing things, it's keep your raincoat on, keep your umbrella handy, and let's probably look for rates to be dropping after mid-year. But we'll see. But it's probably going to be a half a point next week or so, I think 16th, 18th from the Fed. And then also they're going to announce economic stats. So go take a look at that. And if you're not looking at that for your business, these are the things that you should be.